Today, folks, TD stock is getting absolutely wrecked. It is crashing on the back of earnings, and we need to talk about if this is a buying opportunity or if the uncertainty is too great that this is potentially a dividend trap. We also need to broad view the entire sector because we've got a lot of earnings that have now baked in, giving us clarity on where the sector is going as a whole and kind of what's been going on with the underlying economy. Now, like Pokemon cards, I've always suggested that you just collect them all. It's really hard to pinpoint how they're going to perform in this rockier market environment, but the sector has been performing exceptionally well this year. If we take a look at the Globe X Equal Weight Bank ETF, just coming out of August into fall, this thing is up a whopping 20%. And again, somebody like myself, VDY till I motherfucking die, has also performed exceptionally well, giving me about 50% financial exposure to the Canadian financial sector. These two ETFs, I think, really remove some of that volatility because, I mean, even VDY this week is pretty much flat, and HBank this week is actually up on the bank earnings. So this is why you got to be a little bit more cautious if you're hand selecting stocks, because you're taking on that added risk and that uncertainty if we're not sure how these earnings were going to look, right? And you can get a pretty healthy yield here. Globex pays a 4.11% with an extremely low expense ratio, lower than VDY. So it really just comes down to your personal risk tolerance. But let's talk about these banks. Let's get into TD. If you are on a path to financial independence, if you damn well one day want to retire early, join me on that journey by subscribing because TD right now is paying out a record yield. Throughout its entire history, it has never paid a yield this high as Canada's second largest company. Now that it's down 31% from basically its all-time high in 2022, the question is do we have farther to go? Is it finally time to buy? Well, let's get into the news that's driving this insanity, because basically throwing in the towel, TD stock sinks as bank suspends guidance amid review. And this is what's scaring the crap out of people. Basically, shares sank Thursday with investors disappointed by the lender's decision to suspend guidance while it conducts a strategic review as consequence of its anti-money laundering settlement in the United States. TD missed quarterly profit estimates, but that was nearly an afterthought as analysts sought to find a narrative with TD's targets no longer clear, according to Jefferies analyst John described for the fourth quarter results is irrelevant to its outlook. Ahead of Thursday's earning call and basically offered even less enthusiasm in the post-call note to investors. Now, while the quarterly earnings were marred by several factors, including sustained heightened credit losses, catastrophic losses in its insurance segment, and rising costs, our key takeaway was the suspension of TD's medium-long-term guidance. And I really want you to soak that in, because this is the articles that are just deteriorating TD's future, because there's no guidance. We don't know what the hell is going on right now. They're in the midst of charges. They're in the midst of basically we're seeing loans come into renewal. 60% of all loans are renewing in the next couple of years, and that's putting a lot of pressure on the Canadian banks because, if I'm making the same income, but now my interest rate goes from 1% to 3 or 4%, basically the bank says you're putting us at risk. And the regulators told us that we need to put more money aside by law to ensure that if you default, we can cover any losses that might, ensue. So I'm honestly taking a look at these earnings across all the banks, and I'm still in a relatively bullish, circumstance. I still think we're in a really good situation, that there's still potential for a relative soft landing when it comes to the Canadian real estate market, because we have not seen a crash. And so long as real estate doesn't crash, the banks can still recover, any mortgages that, come into default from lack of payments. I think across the board, if you take a look, we're still growing at exceptional rates. But you have to understand, when you pair the concern of loan loss provisions and protections against the anti-money laundering that's been going on, it's a perfect storm to destroy the stock, right? So take a look at revenue. I mean, revenue is sitting at $15.5 billion, which is up from $13 billion this time last year. Just look at the last 12 months. From $50.6 billion to $57.2 billion. I mean, we're not talking about terrible growth here by any metric. These are great growth numbers, but when you dig into it, this is the wild card, right? Because they already put a lot of money aside to deal with this, but obviously there's still a lot of tension in the company. But if we just take a look at provisions for credit losses at $1.1 billion, still going up quarter over quarter is quite concerning to me. This is a trend. We don't want it to remain our friend. It is starting to level off a bit, which is nice to see. But again, we want to see those trends reverse, but before I think we get a continued, substantial recovery. But if we take a look at the net income here, yeah, it's not great if you compare it to, this time last year, 3.2 billion versus 3.4. However, again, if you are a dividend income oriented investor, you have a tolerance for this kind of risk. You think that this news is going to get behind us at some point, and it's offering, a suppressed stock price for eventually better earnings in the future. you could buy this. I mean, the dividend yield sustainable, right? I mean, their payout ratio is still exceptionally low. It's why people buy the banks. They can ride through these periods. It's why you hold them for these reasons, because they can weather the storm. But if we take a broad view of the other banks, how have they held up, just in the face of loan loss provisions and not dealing with the fines that TD is facing? Well, it's a mixed bag, right? We saw BMO absolutely be the most fascinating stock of the earnings season. It dropped miserably. I mean, the thing dropped 4% on the earnings announcement to only become the best performing bank of the week. I mean, Bank of Montreal's up 9% against the rest of the banks, right? Which is just incredible. So let's talk about BMO real quick and just get a kind of view of what's going on here, because now it's offering a great return year to date. And if you were able to catch those very bottoms, I mean, you saw 30% pump literally just within the last couple months. So if we read into it, this is another article from Morningstar saying the Bank of Montreal earnings reversal of legal provisions helps, but credit cost still weigh. So basically, BMO had this really lucky circumstance where they got to bank an extra $870 million on a reversal in a legal provision from 2022. However, excluding this one-time gain, the bank's results were considerably less attractive as elevated credit provisioning remains a headwind. Net revenue increased 7.7% from last year, though, which is, like I said, all the banks somehow continue to grow, right? Take a look at revenues, $8.9 billion versus 8.3 this time last year. If you look at the fiscal 2024, whoo, baby, what great income. 32 versus 29, can't complain, right? But again, provisions for credit losses, total provisions increased to 1.5 billion from 906 million just last quarter. There was excelled loan losses with BMO, which is highly concerning. These trajectories are not what we want to see, and not all banks were like this. Bank of Nova Scotia, there were some other pretty good earnings from the banks, but if we do dive into this again, the yield is highly sustainable here. No concerns from that aspect. Payout ratios at 52%. All in all, again, not necessarily the worst earnings, but again, net income at 1.5 billion, not as good as this time last year where it was 2.2. So again, they were able to obviously add that extra income that boosted the stock, but I'm surprised at the trajectory of BMO, because it's just been one of the worst posted banks. So I'm surprised it's up this much. But again, this is just investing. We don't know what tomorrow brings. This is why we don't speculate and gamble on what's going to happen tomorrow. You're better off just, again, Pokemon carding it, collect them all as a whole, because right now TD might be the second largest holding in VDY, which I'm going to buy till I motherfucking die. But you got to understand, BNS might actually overtake TD soon. BNS has got almost $100 billion market cap and is starting to catch up to Toronto Dominion at 128. So that's why I like market cap weighted ETFs, or again, these equal weighted bank sector ETFs, because it just prevents you from, these unknowns that come into play, especially in a very unforgiving market environment where we're not exactly sure what's going on for the financial sector. But I'm going to pass the question off to you. I'd love to know what you think about all of this in that comment section below. And if you're buying TD, if you're buying any of these equal weight bank ETFs, if you're buying VDY, I'd love to hear about all of it.